أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. How are you all? Alhamdulillah, very good. So we have a session today that is very involved and very important. So I need 100% or more than 100% if possible of your attention, right? So tomorrow is Thursday. I'm sorry, today is Thursday, tomorrow is Friday. Everybody's happy, everybody's feeling light. And I need you to focus with me 100% to understand what we have today. Are you ready? We discussed the first step in the monetary unit sampling method in an audit procedure using the monetary unit sampling method, which was planning. The second step is to perform the audit. In it, we have two tasks, two activities. The first one is to select the sample items, and the second one is to perform the audit procedure. Both of these activities are very involved. How do we select the sample items? Which items to select in our sample? The first point in selecting the sample items is that probability proportional to size is used to select the items, meaning the larger the sample item is going to be, the larger the probability is of selecting that item in the sample. So my question to you is, if you have two accounts receivable balances, one is $5,000 and the other one is $1,000, which one of these two has a greater probability of being selected in your sample item? You have two numbers, 5,000 and 1,000. Which one has a greater possibility of being selected if probability is based on size? Right, 5,000. 5,000. 5,000 has a greater chance. So the larger the number is, the greater the probability is of it being selected in the sample size. So that's the first point. The second point is the sampling interval is calculated by dividing the book value of the population by the sample items. So let's say you have the population book value of 300,000 and sample size is 100. Let's say both of these are available to you, these two numbers, the population book value and the sample size. The population book value is the entire balance. So let's say you have accounts receivable. The entire accounts receivable balance is 300,000, or you have inventory, the entire inventory balance is 300,000. So that's what we mean by population book value. So we have 300,000, the sample size is 100. How do we calculate sampling interval? $300,000 divided by 100. Very good. That will equal to 3,000, right? That will equal to 3,000. So that's how we calculate the sampling interval. We need to calculate something called the sampling interval, and we're going to use that. How? We'll come to that in just a minute. The third is each individual dollar in the population has an equal chance of being selected, and items or logical units greater than the interval will always be selected. What does this mean? This point, to summarize this point and to take the benefit from this point, is that any balance that is greater than the sampling interval, in our example, $3,000. If you have a balance that is 3,000, more than $3,000, that balance will always be selected in your sample. That balance will always be selected in your sample. So that's what this third point means. That doesn't mean that balances less than 3,000 won't be selected. They will also be selected, but there may be an item, there may be a balance less than 3,000 that is not selected. But if there is a balance that is more than 3,000, it will always be selected. You remember I showed you the general ledger of a client where the accounts receivable is made up of individual balances. Remember North Supermarket, West Supermarket, Big Supermarket. Last time I showed it to you. Any balance, individual customer balance that is greater than the sampling interval will always be selected in your sample size. So the probability proportional to size sampling method facilitates that all of those numbers that are greater than the sampling interval will be selected. Is this point clear? Are you following? I need you to stay with me because we haven't come to the difficult part yet. Okay? Now, here is the involved part. But because you're smart, you will understand. It's not rocket science, and you have come to this level by going through all these other classes, so you can understand this, inshallah. You stay with me. We have information here that says the book value of accounts receivable is $2.5 million, $2,500,000. What does this mean? Forget this cumulative dollars and sample item. Forget these two balance, these two columns. Don't worry about these two columns that say cumulative dollars and sample item. Just focus on this number, this balance right here, and this list right here. What is this list? This is a list that you got from your client that shows all those customers that your client has with an accounts receivable balance. So all of these customers of your client has an accounts receivable balance. And if you add all of them up, it equals to $2.5 million. It equals to $2.5 million. So if you go to your client's balance sheet, under the first section, which is current assets, you will find cash. Right next to cash, you're going to find accounts receivable. That number that shows up on the balance sheet that says accounts receivable is how much? What is that number on the balance sheet? Gentlemen, what is the accounts receivable balance on the balance sheet? $2.5 million. It's a very simple question, right? You should know this from your financial accounting class, right? If you pay attention, you could answer, all of you could answer this question. But I'm not getting an answer from most of the students. I'm not asking a difficult question, but I don't see that you're involved. I don't see that you're answering A very, very basic, simple question. Only one or two students are answering. What about the rest? This $2.5 million is the account that is showing up, is the amount that is showing up on the balance sheet, right? The independent external auditor's job, our job, is to give an opinion on whether this $2.5 million is truly and fairly stated or not. That is our concern. And this $2.5 million is made up of a couple of hundred customers, and we cannot verify all the individual balances from all of these customers because it takes a long time to do so. So we have calculated a sample size, which is 93. So we are going to calculate using the book value and the sample size a number that we call sampling interval. So we're going to calculate something called the sampling interval, which is taking the book value of the population, which is 2.5 million, and dividing it with the sample size, and it gives us 26,882. It gives us 26,882. Now, we are going to now go to this list, and we're going to select from this list 93 customers to do our audit procedure. We're going to look at the reasonableness or the accuracy of 93 of these customers' accounts receivable balances. How do we select these 93 items? Step number 1, we calculate the sampling interval, which is taking the population balance and dividing it with the sample size, giving us this number 26,882. Step number 2, we tell our statistics software to generate a random number. And it generates a random number, 3,977. Then we come to this list. Now, let me explain to you this second column with numbers. It says cumulative dollars. How is this column calculated? You go to this balance, and it is the total of all the items until this number. So 2,350 is 2,350 right here. Very good, Hamza. We add 2,350 with 15,495, and we will get 17,845. We add 945 with that, we will get 18,780. We will add 21,893 with the 18,780, and we'll get 40,673. So we come down this column by adding the next number. Clear? How we get the cumulative numbers? How we get the cumulative dollars? All right. So customer number 1. Which is our customer number 1 that we are going to select for confirmation? We take this random number and we come to this cumulative column, cumulative dollars, and we see, do we have this 3,977 number here? Do you see this number anywhere in this column? Do you see this 3,977? You don't see it, right? So we will go to the next number. The next number is 17,845. There is nothing any closer to the random number. The closest number, that is the next number, right? We have to go to the next number. We cannot go to something below the number. So we go to the next number. This is the audit procedure. You just have to remember how to do this. So 3,977. The next number is 17,845. So our first sample is Edmonton Hospital. So we are going to take Edmonton Hospital, which has a balance of 14,495. And we are going to send a letter to Edmonton Hospital like the one that you have seen in the previous class. You remember the letter I showed you in the last class? If you do not remember, you can go and revisit the video. Anyone remember? Sharad, do you remember? Faisal? Remember the Men and Boys Corporation? Yes, right? Hamza, you remember the letter I showed you? So we would send a letter to Edmonton Hospital saying, is this balance correct? So this is going to be our first sample item. Like this, we're going to select 93 from this list, right? How do we do that? The next item that we're going to select is in the following way. We will add the random number with the sampling interval of 26,882, and we will get this number 30,859. We'll take this 30,859 number to this cumulative column, and we do not find 30,859. So what is the next number? The next number is 40,673. Therefore, our sample number 2 is Good Hospital. Do you follow? Okay. If you do follow, you do the next calculation. My question to you is, and I need full proper calculation. I need you to show me full proper calculation. First question is, how do we get this number, 57,741? Where does this number come from? How do we get that number? We get that number by adding 30,859 plus 26,882, and that gives us 57,741. Very good, Sharat. Now we have this 57,741. We take this number and we will compare that with which column? I need you to tell me the title of the column, the name of the column that we're going to take this number to. What is the name of the column? The title of the column? No, the title of the column, not the customer. You're jumping ahead, right? You're one step ahead. Come back. The title of the column is cumulative dollars, right? The title of the column is, very good, cumulative dollars, right? So we come and we try to find this number. Do we have 57,741 in that column? Do we find that number? Do we see that number exactly? Do we have 57,741 in the cumulative dollars column? Quickly, quickly. Yes or no? No, right? We don't. What is the next number? The next number. Next number 257,741. What is that number? Tell me that number in the column. 77,190. Very good. 77,190. So now, Hamza, tell me the name of the customer who is sample number 3. Tell me the name of the customer who is sample number 3. ZP Company, right? ZP Corporation. Very good. Now let's go for sample number 4. 84,623. How do we get that number? 84,623. How do we get that number? What is the next step? What are we going to add? 57,741 plus 26,882. Very good. So we get 84,623. We bring it to the cumulative column. We don't have that number. What is the next number? What is the next number? Anyone? 91,306. The next number. No, Hamza, that is the previous number. The next number. We have to go to the next number, right? 79,046 is the previous number. We have to go to the next number, the next one, right? 91,306. So, what is the name of the customer? Sample number 4. What is the name of the customer? Bede Hospital Centers, right? Bede Hospital Centers. Like this, we go to 5th, 6th, 7th, all the way to 93. We take 93 samples from this list. Clear? Okay. Now we take the 93 and we're going to send a letter to every single one of these 93 customers saying confirm the balance, confirm the balance, confirm the balance, and they either say yes, the balance is correct, or they come back and say no, there is a difference. Okay, so we're going to do the audit procedure. Are you following? Now, once we get the letters back, right? Once we get the letters back, we have to do some calculations with what we find, and we have to draw the conclusion. How do we do that? We have to first calculate something called a projected misstatement and an upper limit. What are those two? I will come to that in just a second. So far, the information we have are as follows. Book value, 2.5 million. That is the number on the balance sheet. Then we have the tolerable misstatement, which is given to us in this case, but in real world, the auditor decides that based on what we have discussed previously, based on the judgment and information the auditor knows, and based on how important this account is, etc., etc. So the tolerable misstatement, there is no difficulty in understanding what we mean by tolerable misstatement. Yes? You're with me 100%. We discussed this many times. What does tolerable misstatement mean? Right? Say yes if you agree. Sample size is 93. You know what that means. Desired confidence level is 95%. Everybody should know what that means. 95% confidence means we want to be 95% sure that the sample is, what is the word? What is the word? We want to be 95% sure that the sample is, what is the word? This will get you 0 marks. Tell me the word. Representative. Very good. Representative. Right? Expected amount of misstatement, 25,000. When we say expected amount of misstatement, that means the expected amount of misstatement in the what? In the what? Tell me the right word. The expected amount of misstatement in the, come on guys, population. Very good. Expected amount of misstatement in the population. And sampling interval, we just calculated. It is calculated dividing two numbers that we have on this slide. What are those two numbers? How do we calculate 26,882? Quickly, the two numbers we have on this slide that are used to calculate this. Quickly. 2.5 million divided by 93. Excellent, Hamza. 2.5 million, right? 2.5 million divided by 93. Okay? Excellent. How I wish this class was face-to-face. How I wish. Now, please follow my next question very carefully. Please. Let's say, are you listening? Let's say you verify all of those 93 customers' balances, and every single one of them come back and say the balance is accurate. In your sample, all 93 customers say the balance is exactly what you say in the letter. That means there are no errors in your sample. The question is, does that mean you have no errors in the population? Sharat says no. Anybody would like to differ? So even if you don't find any mistakes in the sample, there are mistakes in the rest of the population, for sure. So to know how much is the misstatement in the population, even if you did not find any errors in your sample, you need to calculate something called the upper misstatement limit. You need to calculate the upper misstatement limit. How is that calculated? It is calculated using the table that you see. Here on the left side, you have something called the number of errors, which means these are the number of errors you found in your sample. And since we are using 95% confidence level, we will go to this number right here, which says misstatement factor 3.0. To calculate the upper misstatement limit, the formula is you take the sampling interval of 26,882 and you multiply that with 3, which is the misstatement factor. It comes from this table and you get 80,646. This is the upper misstatement limit. This number is telling us that even if you never found any error in the sample, you would assume that there is an amount equal to $80,646 present in the population of 2.5 million. So the $2.5 million is inaccurate by 80,646, even if you never found any errors in your sample. Is this point clear? Do you follow? Okay. No, Sharat, 80,000 is not the deviation. The word deviation is not used when you are dealing with numbers. Remember that. The word deviation is not used. The word deviation is used in which case? You deviate from what? You deviate from what? Remember, you deviate from controls. So, not following a control is called a deviation. Having an error in a number is called misstatement. The number is misstated, wrongfully stated. The number has a mistake in it, and that mistake is 80,646 if you never found any errors in your sample. Is that clear? Now, this is our projection, right? This is our projection. In the population, you can only project, but we haven't done the actual audit procedure. This is before we have even called or sent a letter to any one of those customers. Now, let's say we send those letters. We send those 93 letters to the 93 customers of our client, and we ask them, is this your balance? Is this your balance? Is this your balance? And they all reply back confirming the balance except 4. So this is, and because of our limitations, I cannot give you 93 customers whom you're going to send letters to and they will send letters back to you. We have to provide you with this simulated number. We have to give you this number that says, let's say the auditors sent 93 letters and they received 93 letters back. In those 93 letters, they found 4 customers, Good Hospitals, Marva, AXA, and Learnhardt. These 4 customers they found where the book value of your client's records is different than what they confirmed. So your audited value. So what does this table represent? Good Hospital has a book value of 21,893 in the client's records. You send Good Hospital a letter and they come back and they say that 18,609 is the actual amount, and you do investigation and you find that 18,609 is the accurate amount. Therefore, the amount is misstated. The amount is overstated by $3,284. And this $3,284 is a 15% error. So how do we calculate that? You come to the bottom of this table and you see 3,284 divided by 21,893 gives you 0.15 or 15%. So we have a 15% error in this one client, one customer. Are you following how we get to this number? Right? So we have these 3 numbers. Same with Marva. Book value is 6,705. Audited value 4,023. The difference is 2,682. And then the difference is 40%. Right? Again, same calculation. Difference divided by the book value equals to 0.4 or 40%. All right? And then here, no calculation is needed. As you see, 15,000 and it's 0, so it's 100% error, right? So do you understand this first one, second one, and the fourth one? We'll come to the third one. The third one is a number that is greater than the sampling interval. And all numbers that are greater than the sampling interval were selected in the sample of 93 and verified. Therefore, we don't need to calculate any projection because we know the actual in this category. In the category of large numbers like the one in AXA Corporation, in all of those, the total error is 2,500 because we have not left in the population a single amount that is as large as X, except we verified it. So all the other large numbers that are greater than 26,882 were in our sample, and we confirmed all of them. So we only found a mistake in one of them, and the mistake is 2,500, and we are going to use that number. We don't need to calculate any percentage because we took all of those numbers in our sample. Now this is a very, very involved point. Do you understand this? Do you understand why we are not calculating the percentage? Anyone else? If you're having any difficulty, I need to know. I will explain to you in a different way. Everybody understand this point? We will come to the zero error. That is a different topic. We will put that together with this. Okay, we are going to put the zero error with this. Okay, so we have 4 errors here. The first one is a hypothetical situation. Let's say we did not have any errors. We would have an upper limit of 80,646. If we never had anything and no errors, we would not have to look at this slide. We would just take the 80,646 and we will continue with that. But when we go to call the customers, or send the letters to the customers, we do find 4 errors. So the zero error situation does not exist anymore. You follow, Sharat? The zero error situation does not exist anymore. We have 4 errors. Okay? Any other questions? Okay. Now we come to the next slide. Here we have to calculate the upper misstatement limit. We have to calculate the upper misstatement limit based on the errors we found. Okay, we're going to calculate the upper misstatement limit based on the errors we found. And the way we do that is as follows. First, we will put the 80,646, which is the upper misstatement if we never found any errors. That is our first number. So we will add that number. We'll keep that number on top. Okay, for the calculation, we need to keep that number. Why? We don't need to get into that logic because it will take us in a totally different place. We just need to know that we need to put this number. Second, we take the largest error, which is Learnhardt, which is 100% error. As you see here, 100%. We take that company and we multiply the percentage of error with the sampling interval. So 1, which is 100%, times the sampling interval 26,882 equals to 26,882. And we are going to multiply that with this misstatement factor, which is 1.7, which is for the first error. Where does this come from? Where does this 1.7 come from? It comes from this slide right here. You see this 1.7? This is the incremental misstatement factor for the first error. You see this 1.7, right? This 1.7 is coming from here. We take the 1.7 and we multiply this number right here, the projected misstatement of 26,882, and we calculate the upper misstatement limit. Then we take the second error, second largest, which is 40%, from Marva, which comes from this slide right here. Marva has a 40% error, Marva Medical Supply. We take that and we multiply that with the sampling interval, and we get the 10,753, which is the projected misstatement. So 0.4 multiplied with 26,882, we get this 10,753. And we take that and we multiply that with this misstatement factor 1.5, which is the second misstatement factor for the second error. And this again comes from this table right here. You see the second error, error number 2, misstatement factor is 1.5. So you multiply that and we get 16,130. Then we go to the third one, go to hospital, same calculation, 0.15 times 26,882, we get 4,032. Multiply that with 1.4, which is the misstatement factor from the third error right here, 1.4. Right here, the third error, error number 3, 1.4. And we get this 5,645. So these are the 3 errors. And then the fourth one, the error is 2,500. We don't need to go through any of these calculations because the number is larger than the sampling interval. So we take the entire 2,500. And we add all of these numbers and we get the upper misstatement limit of 150,621. I know it's a very, very involved calculation, but do you follow? How we get the 150,621? Gentlemen? All quiet. This AXA Corporation, because the number is greater than the sampling interval right here, this 32,549, we don't have to go through all of those calculations. No projection is needed because we can use the actual difference, because all the numbers in that category, that high numbers, the high numbers higher than the sampling interval, were selected in the sample and we verified all of them. So there is no need to project for those numbers. Okay, so we use the entire amount of error as the error in the population. Whatever is in the sample is in the population because we sampled all of those large numbers. You follow? Okay, very good. Now we take this upper misstatement limit and we come here to draw our conclusion. Okay, we come to draw our conclusion based on the upper limit, and we will continue from here, right? It will take more than a couple of minutes to explain what we have here, so we will continue from here in our next class, inshallah. Okay, which is on Sunday. Please listen to this lecture before you come on Sunday so that you're up to speed. All right, thank you so much. I will see you on Sunday, inshallah. Assalamu alaikum wa rahmatullahi wa barakatuh.